Question number 46. A business is buying its material in a variety of currencies. It has an exclusive supply delivery contract whereby the same logistics expert makes all deliveries to its warehouse on a cost plus basis. Cost plus basis means cost plus the delivery charges. It pays all delivery charges on a per unit basis. Which three of the following are valid explanations of an adverse material price variance measured to include delivery costs as part of the cost per kg delivered? So here they have mentioned that the delivery cost is also the part of the direct material cost. When is there an adverse material price variance? When the actual price of raw materials exceeds the standard price. That is when there is an adverse variance. So the first situation, exchange rate movements. Yes, an unfavorable exchange rate will definitely increase the actual price and cause an adverse material price variance. Extra discounts agreed. Discounts will reduce the prices and it will only give a favorable variance. That is, the actual price will reduce because of discounts and hence that will not cause an adverse material price variance. Increased worldwide demand for the material. Yes, if there is an increase in demand, definitely the price of that material will increase and hence the actual price of materials will increase, causing an adverse material price variance. Extra supply of the material becoming available from new suppliers. Whenever there is an increase in supply, the price will reduce, which means that the actual price will reduce, which will not result in an adverse material price variance. World oil price rises. Now, when the oil price rises, definitely the delivery charge will also increase. So it will lead to an adverse material price variance. Increase in the dividends paid by the delivery business. Dividends. Dividends is just a distribution of profits. The cost will remain unaffected and hence it will not cause an adverse material price variance. Now moving on to the next question. Question number 47. Three reasons for an adverse material usage variance and at the same time indicate poor performance of the production manager. So they have indicated two situations here. First of all, it should be an adverse material usage variance and it should also be because of the poor performance of the production manager. Now, the adverse material usage variance arises when the actual quantity used is greater than the standard quantity. And the poor performance of the production manager is when this increase in actual quantity is due to the inefficiency of the production manager or the production department. So in this question, they have asked whether the following reasons will contribute to an adverse material usage variance and is also because of the poor performance of the production manager. So we will create two columns and we will see whether each of these reasons cause an adverse direct material usage variance, and if yes, we have to again check whether it is a production manager's responsibility. Now, the question further says business has separate managers for production, material purchase, and machine maintenance. So basically, there are three managers in total. Now, the first reason, new supplier offering similar quality for lower prices. Now, since it is similar quality, there is no question of the actual quantity being greater than the standard quantity. There will not be any extra wastage. And as for lower prices, it just causes a direct material price variance which will be favorable. So in short, since we are getting a similar quality raw materials, it will not cause an adverse direct material usage variance. Now moving on to reason 2, inadequate training of newly recruited production staff. Whenever there is inadequate training, wastage is a possibility, which means that the actual quantity used may increase and it may result in an adverse direct material usage variance. And is it the production manager's responsibility? Of course it is, because he was supposed to train them properly. It is the inefficiency of the production manager that he did not train the newly recruited staff. So here again, it is the production manager's responsibility.
Now, reason 3, exchange rate fluctuations causing expensive materials. Just because an exchange rate fluctuations is caused in expensive materials, it will not affect the usage of the raw materials. Expensive materials will just cause the direct material price variance to be adverse, which means that reason 3 will not cause any direct material usage variance. Now, reason 4, machine breakdown due to delays in the annual maintenance schedule. Whenever there is a machine breakdown, there is a possibility that some of the raw materials may be lost, which means that the actual quantity used may actually increase, which would cause an adverse direct material usage variance. Now the question is it the production manager's responsibility? No, because we have got a separate manager for machine maintenance. He was in charge of looking into the annual maintenance. So it is not the production manager's responsibility. Now reason 5, production process changes causing extra losses of materials. Whenever there is extra losses of materials, definitely the actual quantity will increase and hence it will cause a direct material usage variance. And since it is because of a production process change, which is the responsibility of the production manager, yes, this variance will be the production manager's responsibility. Now, reason 6, reduced quality materials bought. Reduced quality materials bought means some of the materials may be wasted because it might break, it might deteriorate. So, definitely the actual quantity used will increase. So, the direct material usage variance will be adverse. Now, is it the responsibility of the production manager? Strictly speaking, anything purchased is the responsibility of the purchase manager. There is a small reason for blaming the production manager because he has to do the quality checks for the raw materials. So the primary responsibility is definitely of the purchase manager, and a subsidiary responsibility could be attached to the production manager as well. So we will place a tick mark against the production manager's responsibility as well. So the three reasons for an adverse material usage variance and at the same time indicate poor performance of the production manager is reason 2 where there are 2 ticks, reason 5 where there are 2 ticks, and reason 6 where there are 2 ticks. Now moving on to the next question.
Question number 48. Which of the following concerning a labor planning variance is true? Now, when do you have a planning variance? Planning variance is due to unexpected or uncontrollable factors. Option A, labor planning variance will always be adverse if the actual labor rates increase. Now, if the labor rate increase is expected, then it will not result in a planning variance. It is only for unexpected factors that a planning variance will arise, which means that option A is wrong. Option B, labor planning variance will be caused by a manager changing the labor mix during the year. The manager is changing the labor mix. Is it an unexpected factor? Absolutely not. So it will result only in an operational variance and not a planning variance. Option C, labor planning variance will be caused by an unexpected government policy to increase labor rates. Yes, this is truly unexpected and hence it will result in a planning variance. Option D, labor planning variance will always lead to a variable overhead planning variance. Now, what is the relationship between labor variance and variable overhead variance? Please note that the standard or the actual hours for labor variance is equal to the standard or the actual hours for variable overhead variance. But the standard or actual rate for labor variance is not equal to the standard or actual rate for variable overhead variance. Do we pay the same rate for laborers as we pay for the electricity charges? No, right? So, a labor rate planning variance, say because of an unexpected government policy hike rates in labor rates, it will not result in a variable overhead planning variance. which means that option D is also false, which means that the right answer is option C. Now moving to the next question. Direct material mix variance tries to establish whether we have used an expensive raw material more or a cheaper raw material more. If you use an expensive raw material more in the mix, then definitely it will be an adverse variance, right? So in the direct material mix variance, it is relatively easy because you have to blindly follow this format and you will get the answer. So how's the format? The first column is the actual quantity. So in this particular example format, we have taken the expensive raw material to be 120 kg and the cheaper raw material to be 90 kg. And then we total the actual quantity and we get the total as 210 kg. Then you carry forward this amount to the total of the next column, 210 kg. In the question, the standard mix of the raw materials will be given. So say it is 1:1. So you have to divide this 210 kg in the ratio 1:1. That is why we have taken 105 kg for expensive raw material and 105 for the cheaper raw material. Please note that this actual quantity and the standard mix will be given in the question. Now the third column is B minus A. Please note that it is B minus A. Never take A minus B. So column B minus column A. So it's 105 minus 120. So you get minus 15 kg for the expensive raw material and 105 minus 90 you get plus 15 kg for the cheaper raw material, and the total of this column will always be 0. Now the standard price per kg, that will also be given in the question, so copy the standard price from the question into column C. And finally the last column is B minus A, that's this column, multiplied by C, that is this column. So minus 15 multiplied by 7, you get 105. And since it's a negative figure, you write adverse here. And the next row, plus 15 multiplied by 3, you get 45. And since it's a plus here, you write favorable here. Since it is 105 adverse and 45 favorable, the net direct material mix will be 60 adverse. Now let's do the question from the exam kit. Question number 49. JC Limited mixes 3 materials to produce a chemical SGR. The following extract from a standard cost card shows the materials to be used in producing 100 kg of chemical SGR. Since this is the standard cost card, this is the standard. So what have they given? They have given the standard mix. It is 5:4:2. And they have also given the standard price. During October, 23,180 kg of SGR were produced using the following materials. So this is the actual quantity of raw materials used. Find out the total material mix variance. So we will just blindly follow the format. We've got 3 materials A, B and C, and actual quantity we will copy from the question. Now we have to carry forward this total of 26,400 to the next column. So that's done. Now what is the standard mix? The standard mix is 50:40:20 or 5:4:2 in simplified form. So you have to divide 26,400 in this ratio, in 5:4:2 ratio. So what will come for A? It is 26,400 divided by 11. What is 11? It's 5 plus 4 plus 2. Divided by 11 in the denominator, multiplied by 5. So that will come for A, and that's 12,000 kg. Now for B, it is 26,400, which is a total, divided by 11, that's the total of the mix, multiplied by 4. That is a ratio for material B. So it is 9,600, and finally for raw material C, it is 26,400 divided by 11, that's the total of the ratios, multiplied by 2.
So it is 4,800 kg. Now the next column is B minus A. So it is 12,000 minus 13,200, negative 1,200 for A, 9,600 minus 7,600. So it's plus 2,000 for B, and 4,800 minus 5,600 or minus 800 for C. And total will definitely be 0. Now the standard price we copy from the question. It is 10, 5 and 9, and we will mark that as column C. And finally the variance column is B minus A, that's this column, multiplied by C column. Let's do the calculation. It's minus 1,200 into 10, so it's minus 12,000, plus 2,000 multiplied by 5, it's plus 10,000, minus 800 multiplied by 9, it's minus 7,200. So the net effect, it's negative 9,200. Since it's negative 9,200, it's 9,200 adverse variance. So we write the material mix variance as $9,200 adverse. Direct material yield variance is all about the input-output ratio. That is, did we use more or less input to get the specified output? So the first step is to calculate the weighted average standard price. What do you mean by that? Now you've got three materials and it is priced differently, 4, 12 and 8. What is the average price of this raw material? That is what we are trying to find out in step 1. So 5 kg at $4, 2 kg at $12 and 3 kg at $8, which means that the average price will be 5 into 4. That's for the first material, and for the second one it's 2 into 12, and for the third one it's 3 into 8. So we have got the cost in the numerator, and this is for how much kg? It's for a total of 10 kg. So 5 plus 2 plus 3, 10 kg goes in the denominator. So we get average price per kg of raw material. So that was step 1. Now step 2. Step 2 is finding out the standard quantity of materials. So just take the input-output ratio which is given in the question. Now in this case, we are using 10 kg of raw material to get 1 unit of output. So that is what is mentioned here. 10 kg of input gives 1 unit of output. Now the actual output will be given in the question. Say it is 3000 units. So you have to find out what is the standard input required for 3000 units. You can substitute here as x and cross multiply and you can solve for x. Now in step 3, the actual quantity of raw materials have to be keyed in. It's a total figure that you have to key in here. And in step 4, you're finding out the direct material yield variance in kg. So that's nothing but step 2 minus step 3. And what is step 2 minus step 3? It's standard quantity minus actual quantity. So that's what is written here. And if the standard quantity is greater than actual quantity, that is, if we end with a positive figure here, then it's a favorable variance. And if the standard quantity is less than the actual quantity, that is, we end up with a negative figure when we do step 2 minus step 3, then it is an adverse variance. So here we got the direct material yield variance in kg, but we want it in dollar. So that's done in step 5. And how do we do the calculation? It is step 4 multiplied by step 1. Or you've already got the direct material yield variance in kg. So you take that and multiply it with the weighted average standard price that you've calculated in step 1, and you will get the answer for direct material yield variance in dollar. Now let's tackle the question.
Question number 50. Product GX consists of a mix of three materials J, K and L. The standard material cost of a unit of GX is given. So what is shown below are the standards. This is the standard quantity of materials required for 1 unit, and this is the standard price of each material. In March, 3000 units of GX were produced. So this is the output and the actual usage was. So this is the actual quantity of raw materials used. Material yield variance for March. So we will go to step 1, the calculation of weighted average standard price of the raw materials. So here we have got the standard quantity and the price, which means that in the numerator it's 5 into 4 for the first raw material, it's 2 into 12 for the second raw material, and 3 into 8 for the third raw material. So in the numerator, we have got the cost for 10 kg of raw material. So what is the cost of 1 kg? In the denominator, we have got the total of the kg, that's 5 plus 2 plus 3 or 10 kg. So the weighted average standard price is 68 divided by 10 or $6.8 per kg. Now, step 2 is a calculation of the standard quantity of materials required for the actual output of 3000 units. So, first we have to take note of the standard input output ratio. For 1 unit of output, we need 10 kg of raw materials. So, that's the input output ratio. For 10 kg of raw materials or input, we get 1 unit of output. So for 3000 units of output, what is the input? So we will take the question mark as x and then we will cross multiply. So x goes in the numerator on the right hand side and 3000 goes to the numerator on the left side. So x is equal to 3000 into 10. So we write 30,000 kg as a standard quantity of materials required for the actual output. Now going to step 3, what is the actual quantity of raw materials used? That's just the sum of all these three that works out to 29,000 kg. And step 4, we have to calculate the direct material yield variance in kg. So step 2 is the standard quantity of 30,000 and step 3 is actual quantity of 29,000. So 30,000 minus 29,000, we end up with a positive balance of 1,000 and hence it's a favorable balance because it's a positive balance. This is just the explanation of step 4. You don't need to write this for the exam. This is just for your understanding. Step 4 is nothing but standard quantity minus the actual quantity. And if the standard quantity is greater than the actual quantity, here the standard quantity, yes, it's greater than the actual quantity. So we end up with a favorable balance. Now going to step 5, we have to calculate the direct material yield variance in dollar. That's nothing but step 4, that is the direct material variance in kg, 1000 kg, multiplied by step 1, that is 6.8, which is a weighted average standard price. So 1000 multiplied by 6.8, it is $6,800 favorable. So the right answer is option A. Question number 51. Which of the following statements is or are true regarding the material yield variance? An adverse total yield variance would suggest that less output has been achieved for a given input. That is, the total input in volume is more than expected for the output achieved. We have seen that in step 4, adverse yield variance results when the actual quantity exceeds the standard quantity. So that's what they have mentioned here. The total input in volume. What is the total input in volume? That's nothing but the actual quantity. That is more than what is expected. What do you mean by expected? Expected is nothing but the standard quantity. So this is exactly the reason for an adverse material yield variance. That is when the actual quantity exceeds the standard quantity. Now elaborating this further, if the actual quantity exceeds the standard quantity, it simply means that excess input has been used. Or in other words, you could also say that less output has been achieved with the given input. So that is what is mentioned in the first part of the sentence. Less output has been achieved for a given input. So in short, statement 1 is right. Now coming to the second statement, a favorable total mix variance will usually result in an adverse material yield variance. Now, when is there a favorable mix variance? Favorable mix variance arises when there is an increase in the quantity of the cheaper raw material. Cheaper raw material is usually associated with lower quality. Not always, but usually
Cheaper raw material is associated with lower quality raw materials, which means that there is a high chance that there is a reduction in the quality of raw materials, which means that many of the raw materials may deteriorate, many of it might break, and hence the quantity of raw materials used will be more than the standards. So this will usually result in an adverse material yield variance. So statement 2 is right. Since both the options are true, the right answer is option B.
So this is a format that we have to adopt for planning and operational variance. Planning variance is the result of uncontrollable factors.
Whenever these uncontrollable factors occur, these original standards will become defective. So we are forced to revise the standards, and this difference will cause the planning variance. And in order to assess the operational performance of the divisional managers, we have to compare their actual performance with the revised standards, because only the revised standard is valid under the revised circumstances. Now here I am not going to elaborate on the logic and the details of the formula. There's a separate video for planning and operational variance. Students who have got a doubt may refer to those videos. Now let's move on to the question. So here they have asked us to find out the adverse planning labor efficiency variance. This is the format for planning and operational variance relating to direct labor efficiency. So for the time being, I will copy this part because this is the part where you have to key in the figures from the question. So I have copied the format here. Now we will start reading the question. A business advisor had planned to use 3 hours of labor per service. Planned to use 3 hours of labor per service. So planned is basically the original standard. In the format, the direct labor hours per unit pertaining to the original standard should be keyed in here. So I am keying in 3 hours per unit in this slot. So reading that sentence once again, a business advisor had planned to use 3 hours of labor per service. Per service means per unit also we can say, on 700 client services or 700 units in June. Now this 700 units is just the budgeted production. But we don't need the budgeted production. What we need here is the actual production. So completely ignore 700 units. Labor is paid $40 per hour. So this is the standard labor rate. So that will come here under the original standard rate. So that's 40. Now moving to the next sentence, in June. So now we are going to read the actuals. Till now we were reading the plan or the budgets or the standards. So in June, there were actually 900 services provided. Actual production is 900. So that will come here under actual production. Total labor hours were 3,240 and the actual labor rate was $42 per hour. So both these pertains to the actuals. So 3,240 is the actual hours and $42 is the actual rate. The advisor has since discovered that due to a change in legislation, change in legislation means it is an uncontrollable factor, which means that now they are going to talk about the revised standards. That meant extra client responsibilities. The budget should have provided for 3.5 hours of labor per service. So the original standard stipulated 3 hours per unit, but as per the revised standard, it is 3.5 hours per unit. So we key in against the direct labor hours per unit next to the revised standards. So 3.5 comes against the revised standard. What is the adverse planning labor efficiency variance for June? Now, I've just mentioned the key point as a footnote in yellow. That is RSH. What is RSH? The revised standard hours, and OSH. OSH is the original standard hours, is always calculated for actual production and never on the budgeted production. So now we will calculate the revised standard hours and the original standard hours. So direct labor hours required per unit is 3.5 hours. So that was for 1 unit. So for 900 units, what is the revised standard hours? It is 900 multiplied by 3.5 or 3150 hours. Likewise, as per the original standard, for 1 unit, 3 hours is required. So for 900 units, how many hours are required? So that's 900 multiplied by 3 or 2700 hours. And regarding the revised standard rate, they have never said anything about revising the rates, which means that the original standard rate is also the revised standard rate. So now all the figures in our format are complete. Now it's only a question of applying the formulas. So we will copy the formulas also. These are the formulas for direct labor efficiency variance. This is the total direct labor efficiency variance, which is split into the operational variance and the planning variance. What have they asked us to find out? They have just asked us to find out the planning labor efficiency variance. So for this question, we need to solve only the planning variance. Substituting the figures in the formula, original standard hours is 2700, revised standard hours is 3150, original standard rate is 40. The variance is $18,000 adverse. Why is it adverse? Because it's a negative balance. So whenever you write the formula, always remember that you should write the bottom figure first and the top figure subsequently. Only then you will get that positive and negative for the favorable and adverse variances correctly. Or logically also you can think, because originally we had budgeted for 2700 hours. But because of the revision, now we are forced to take 3150 hours. So taking more hours is definitely adverse, right? So it's an adverse variance. So that's the final answer. Now moving on to the next question.
The next problem is relating to the planning variance of the direct labor rate. Now, whether it is direct labor rate or whether it is direct labor efficiency, this part remains the same. This is the portion where you key in the figures from the question. In case of direct labor rate variance, we are concerned about these rates inside the bracket. That is the difference in the rates, and outside the bracket it is always actual hours. So with this understanding, we will tackle the next question. So I have copied the format here. Question number 53. A company has recorded a favorable labor rate planning variance for the year of $40,000. So planning variance is coming here. So we will key in $40,000 favorable here. It was discovered that while actual labor rates were $60 per hour, so we will enter that too. So actual rate is 60. Revised standard rate for labor should have been $70 per hour. So the revised standard rate is also given. So revised standard rate is $70. For the actual hours worked of 20,000. So actual hours work 20,000, we will enter it under actual hours. What was the original planned labor rate per hour for the year? So they are asking us to find out the original standard rate. So that is unknown. So we will take that as X. So here I have just added the formulas also. Focus on the planning variance. 40,000 favorable. And what is the formula? Original standard rate minus revised standard rate multiplied by actual hours. So original standard rate we have taken as X, revised standard rate we know it's 70, and actual hours we know it is 20,000. So we get an equation here, 40,000 favorable. Here we have to put a plus sign because it's a favorable variance. If it was an adverse variance, please note that here it will be a negative sign. But thankfully in this particular case, since it is a favorable variance, it's a positive sign. So plus 40,000 is equal to x minus 70 multiplied by 20,000. So I've just copied the equation into the next slide. So plus 40,000 is equal to x minus 70 into 20,000. Taking 20,000 to this side, it's 40,000 divided by 20,000 is equal to x minus 70. So x is equal to $72 per hour. So we've got the answer. The original planned labor rate is $72. Now moving on to the next question. This is the format that you have to follow for finding out the sales mix and the sales quantity variance. In the sales mix variance, we are trying to find out whether the mix of the products is different from the budget. If you notice here, the product orange juice has got a profit per unit of $2, while lemonade has a profit of just $1 per unit, which means that orange juice is a more profitable product and lemonade is a less profitable product. Now in sales mix variance, we are trying to find out whether we are selling a more profitable product more or less. So the first column is actual sales in units. So this will be given in the question. So here it is 1100 units for orange juice and 1100 units for lemonade. So the total works out to 2200. Then you have to copy the total to the next column. So 2200 will come here also, and then you have to take note of the budgeted mix from the question. In this case it is 1:9. So you have to divide this 2200 in the ratio of 1:9. So that's what's done here. So as far as orange juice is concerned, it's 2200 divided by 10. How did I get 10? That's 1 plus 9. Multiplied by 1. What is 1? 1 is the share of the orange juice. So we get 220 here. And as for lemonade, it's 2200. That's the total. Divided by 10. That's the total of 1 plus 9. Multiplied by 9, which is a share of the lemonade. Now all that you have to do is you have to follow the instructions which is given on the top of the table. So it's A minus B to get the variance in units, and standard profit or contribution per unit will be given in the question. And if it's absorption costing, use standard profit, and if it's marginal costing, use standard contribution. And to get the variance in dollar, you have to just multiply the A minus B column with the C column. That is, this column multiplied by this column, you will get the variance in dollar column. And finally, you total it to get the net variance in dollar. So here we are focused about the mix of the products. Now in sales quantity variance, what we are bothered about is whether we have sold more or less quantity when compared to the budget. So the second column of the sales mix variance becomes the first column of the sales quantity variance. It's the same thing. And then you have to copy the budgeted sales, that will again be given in the question, and then just follow the instructions which are given on the top of the table. So we will do the next two questions with these formats in mind. Y sells two types of balls, A and B, and you're asked to find out the sales mix variance. So we will just copy the table. So while reading the question itself, we'll enter the details in the format. So these are the two products A and B. The standard contribution from these balls is $4 and $5 respectively. So we know that B is the more profitable product, and standard profit per ball is $1.5 and $2.4 respectively. So in this column, should we use standard profit or standard contribution? We should not use standard profit because further down they have said Y values its stock of balls at marginal costing. So you have to take the contribution here and not the profit. So let's just correct the heading of the second last column. Okay, so I've changed it into standard contribution simply because marginal costing is followed. Okay, so the standard contribution is $4 and $5. So we copy that into column C. The budget was to sell 5 type A balls for every 3 type B balls. So what's the budgeted mix? That's 5:3. So we will write that on top of column B because that's the budgeted mix. Actual sales were 240,000 balls. Okay, so the total of the actual sales is given. So we will enter that too, which is 20,000 balls higher than the budget. Whenever we are comparing it with the budget, that relates to the sales quantity variance. In mix variance, we don't need to compare it with the budget. So completely ignore this sentence for calculation of mix variance. The actual sales included 200,000 of type A balls. Okay, so type A balls is 200,000, which means that the balancing figure will be 240,000 minus 200,000, or it is 40,000 units for product B. First, we have to copy the total of column A to the total of column B. And then we have to divide 240,000 in the ratio of 5:3. So for product B, it is 240,000 divided by 8. What is 8? It is 5 plus 3 multiplied by 3, which is a share of product B. So we get 90,000. And as for product A, 240,000 divided by 8, that's the total of 5 plus 3 multiplied by 5, which is a share of A. So it is 150,000 units. Now A minus B, it's 200,000 minus 150,000, so we get 50,000. And as for product B, it's 40,000 minus 90,000, or it is negative 50,000. So the total is 0. Now the last column, that's a variance in dollar. So you have to multiply A minus B column with the C column. That is this column multiplied by this column. So 50,000 positive multiplied by 4, you get $200,000 positive. And negative 50,000 multiplied by 5, you get negative $250,000. So the total variance is 200,000 minus 250,000, or negative 50,000. Since it's a negative figure, it's an adverse variance. So the sales mix variance is $50,000 adverse. And why is it adverse? Because product B was more profitable. As per the budgeted mix, the more profitable product, that is product B, we had to sell 90,000 units, but we sold lesser quantity of 40,000 units. That is the reason why we are ending up with an adverse variance. Now the next question is relating to the calculation of sales quantity variance. So what did we see in the format? The second column of the sales mix variance becomes the first column of sales quantity variance. So just note the figure, actual sales and budgeted mix 150,000 and 90,000. Okay, so I've just copied that here. As I said, they are asking you to find out the sales quantity variance. The question remains the same. Now coming to the second column, budgeted sales in units. So this is where they have talked about the budgeted figures. Actual sales were 240,000 balls. So that's here, which is 20,000 balls higher than the budget. So the actual sales is higher than the budget by 20,000 balls, which means that the budgeted sales in total will be 240,000 minus 20,000, or 220,000 units. And since we already know that the budgeted mix is 5:3, we can easily find out the budgeted sales for A and B. So 220,000 divided by 8, which is the total of 5 plus 3 multiplied by 3, we get 82,500 units. And as for A, it's 220,000 divided by 8, that's 5 plus 3 multiplied by 5, which is a share of A. So we get 137,500 units. Now we just follow the instructions that's given on the top of the format. So it's A minus B, so it's 90,000 minus 82,500, so it's 7,500 for B. And as for A, it's 150,000 minus 137,500, so it's 12,500 for A. Now the last column, variance in dollar, A minus B column multiplied by C column. So it's 12,500 multiplied by 4, or $50,000. And as for B, it's 7,500 multiplied by 5 or $37,500. So the total of the sales quantity variance works out to $87,500. Since it's a positive figure, we have a favorable variance as a sales quantity variance amounting to $87,500. And why is it a favorable variance? Because the budgeted sales was just 220,000 units. We have achieved a much higher quantity. We have got a figure of 240,000 units as the actual sales figure. Now moving on to the next question. The next question relates to the market share and market size variance. Now, market share is also known as operational variance and market size variance is also known as planning variance. Now, I want you to understand the meaning of market size and market share. Market size means the total number of customers who are present in the market, and market share is the number of customers buying the company's products. Planning variance is because of uncontrollable factors. For example, COVID. Now, when COVID strikes, what happens is the market size reduces, or the total customers that are coming into the market will definitely reduce. So, this original budgeted unit will become meaningless. We will have to revise the budgeted units. Now the next question is relating to the sales volume variance, and they've asked us to find out the market share variance. So let's take a look at the question. Question number 56. So going to the last sentence, we are supposed to find out the market share variance. So what we will do is we will copy the format, and as and when we read the question, we will key in the figures in that format. Now I would like to show a small working note that will definitely help you to tackle any type of question relating to market share and market size variance. So if the original market share is given in the question, you have to enter that in the working note. Then the original market size, if that is given in the question, enter that too. Revised market size in units, if that's given in the question, enter that too. If actual market share is given in the question as a percentage, then enter that too in the working notes. And the relationship between these are the original market share's percentage multiplied by the original market size. You will get the original budgeted units. That's here. And if you apply the original market share percentage to the revised market size in units, you get the revised budgeted units. That's here. And if you apply the actual market share percentage to the revised market size in units, you get the actual units. So that's here. Once you have this format in place, then whatever details are given in the question, you will not be confused. It is very easy to find out original budgeted units, revised budgeted units, and the actual units. Now we will read the question and simultaneously we will enter the figures in the format as well. A company holds a 2% share of the clinical machine market, which means that 2% is the original market share. So we enter 2% against the original market share. And the total market demand has been constant at 250,000 machines. The total market demand. So that's nothing but the original market size. Now budgeted selling price for each machine is $10,000. So we have the original selling price at $10,000. Now further in the question, they have never said anything about revising the selling prices. So against the revised selling price and the actual selling price, we will key in $10,000 as well. Budgeted selling price for each machine is $10,000 and standard contribution is 10% of the budgeted selling price. So that's the original standard contribution. So that's $10,000 multiplied by 10%. So the original standard contribution works out to $1,000. Company's actual sales volume was 5,600 machines. So we key in 5,600 units as the actual units, and also the actual units can be keyed in here. No calculation was involved here because it was directly given. Total market demand for machines though had risen to 300,000 units, which means that the market size has been revised. So that's 300,000 units. What is the market share variance? So we will complete the working note. What is original budgeted units? That's 250,000 multiplied by 2%, or it is 5,000 units. Now what is revised budgeted units? That's 2% multiplied by 300,000. So that's 6,000 units. So we will enter the original budgeted units and the revised budgeted units in the format as well. So original budgeted units 5,000 units and revised budgeted units 6,000 units. So the format is complete. Now in this particular question we need to calculate only the market share variance. So market share variance is here. So all that we have to key in is the actual units, revised budgeted units and the original standard contribution. All these other details were not required, but it is only for your understanding that I have completed the format. Because in the examination, if you are asked the planning variance or if you are asked the sales price variance, and you should be able to attempt it, right? So for this question where you are asked to find out the market share variance, you could have restricted your calculation to finding only these details, that is actual units, revised budgeted units and the original standard contribution. So substituting the figures in the formula, actual units is 5,600 units, revised budgeted units is 6,000 units and original standard contribution we've calculated as $1,000. So what's the market share variance? It is negative 400,000. Negative indicates adverse variance. So it is $400,000 adverse. Now I want you to specifically note the way in which these formulas have been written. Because it is related to sales, you have to write the top figure first and the bottom figure subsequently. Here again, see, it is a top figure which is written first and the bottom figure has been written next. Whenever variances are relating to sales, you have to write the top figure first. Only then you will get the negative and positive figure correctly for adverse and favorable variances. Moving to the next question. Question number 57. A profit center manager claims that the poor performance of her division is entirely due to factors outside her control. She has submitted the following table along with notes from a market expert which she believes explains the cause of the poor performance. So if you see here, actuals for last year is given, actuals for this year is given and the budgets for this year is also given. After adjusting for external factors outside the manager's control, in which category or categories is or are there is evidence of poor performance. And we will take a quick look at the market expert notes and then we will redraft our final answer. So regarding the sales volume in units, what has the market expert said? The entire market has decreased by 25% compared to last year. What was the last year sales? 400 units. So if the entire market has reduced by 25%, then the budget for next year, should it be 500 units? No, right? It should show a reduction of 25% and the product will be obsolete in 4 years. So there is no question of stocking those particular goods in the godown. We should somehow sell it because the expiry date is within 4 years. Now coming back to this first sentence, the entire market has decreased by 25% compared to last year. So last year sales was 400 units. So the budget should have been 400 units multiplied by 75%. Why 75%? Because they have said that the drop in the market is 25%. So the budget should have been 300 units. So this is an unrealistic budget. And as far as the actuals are concerned, they have actually achieved 300 units. We will put a tick mark against the sales volume actuals in units indicating that there is no bad performance. Now coming to the sales revenue part. What did the market experts say? Rivalry in the market saw selling prices fall by 10%. Let's see what the existing selling prices are. So last year, units sold 400 units, sales revenue 40,000. So what's the selling price? Selling price is $40,000 divided by 400, or the selling price was $100 per unit. And even in the budget, they have budgeted for a selling price of 100 because 500 units into 100 gives $50,000. But since the selling prices fell by 10%, you should modify the selling price, right? So the selling price should have been 100, that was last year's selling price, multiplied by 90%. Why 90%? Because the selling prices have fell by 10%. So the budgeted selling price should have been $90. Now let's look at the actuals. What is the selling price actually achieved? It's $28,500 divided by 300 units. So the actual selling price works out to $95. So $95 is excellent considering that when we rework the selling price, we just got $90. So we will put a tick mark against the sales revenue as well. Now coming to the total material cost. As demand for the raw materials is decreasing, suppliers lowered their prices by 5%. Okay, so the material cost per unit should have come down. So last year the material cost was $8,000 for 400 units. So what's the material cost per unit? It's $8,000 divided by 400 units, or the material cost was $20 per unit. And what was the actuals? Actuals is 6,500, which is the material cost in dollar, divided by 300, that's the number of units. So the material cost per unit works out to 21.7. But they have said that the suppliers lowered their prices by 5%. So material cost per unit increasing compared to the previous year is not an acceptable figure. It's an indicator of poor performance. So now coming back to the question, after adjusting for external factors outside the manager's control, in which category is there an evidence of poor performance? So the right answer is material cost only. That is the only case where there is a poor performance. Now moving to question number 58. The finance director of P Limited has produced a table below showing the variance results for the first 3 months for the year. So you have got a material price variance continuously adverse. What do you mean by material price variance adverse? It means that the actual price has always exceeded the standard price. The material mix variance in the first 2 months, it is adverse. What do you mean by an adverse material mix variance? An expensive material has been used more. And in the last month, there is a negligible favorable variance. And as far as material yield variance is concerned, the first 2 months we've got an adverse variance. What is material yield variance? That measures the relationship between the input and the output. So when is there an adverse material yield variance? When the input increases unreasonably, or there is a lot of wastage of the raw materials. That is when the material yield variance turns out to be adverse. So now which of the following is not correct? Purchase manager should be able to threaten to switch suppliers to get better deals and address the adverse material price variance. All the 3 months you've got an adverse material price variance. So definitely the purchase manager should try to get better deals and negotiate for lower prices. So that's right. Now statement B, material mix variance is entirely under the control of the production manager. I'll give you an example. If your product is the fruit punch, so the raw materials are the fruits, right? So say there is a scarcity of a particular fruit, then obviously the mix will have to be altered. So you cannot say that the material mix variance is always under the control of the production manager. So that's incorrect. Statement C, favorable yield variance in March could be the result of operational efficiency. Now in March, what is the situation? The material mix variance has turned out to be favorable, which means that we have used a cheaper raw material more. Now in spite of using a cheaper raw material more, if we could have a favorable material yield variance, that is a favorable input to output ratio, then it could be the result of operational efficiency, which means that statement C is correct. Responsibility for the initial poor performance must be borne by both the purchasing manager and the production manager. Yes, the purchasing manager is responsible for the adverse price variance and the production manager is responsible for the yield variance. That's the input to the output ratio. He's responsible for the wastages or an abnormal use of input. So that's also correct. So finally, the right answer, the statement which is not correct, it is statement B. Now moving on to the next question. Which of the following statement regarding the use of standard cost in rapidly changing environments is or are true? Please take note of these words, rapidly changing environment. Rapidly changing environment, the first thing that should come into your mind is standard costing cannot be applied. Because you cannot have a standard because it's rapidly changing. Now we will read the sentences. So they've asked you which statements are true. Variance analysis results will take into account important criteria such as customer satisfaction or quality of production. Just because the sales are reducing, you cannot say that the customers are dissatisfied, or just because the sales are increasing, you cannot say the customers are satisfied. The increase or decrease in sales may be a result of advertisements or competition. So in order to understand the customer satisfaction, we will have to take a customer review. Variance analysis strictly will not throw light on the customer satisfaction. And regarding the quality of production also, variance analysis might not throw light on an inferior product. Just because the sales are dropping, we cannot say that we have produced an inferior product. It might be due to competition. So strictly speaking, variance analysis does not give so much importance to the customer satisfaction and the quality of production. So this statement is not true. Second statement, achieving standards is suitable in most modern manufacturing environments. I said standards are absolutely useless in a modern manufacturing environment which is rapidly changing. So this statement is also false. So the true statements, the right answer is neither 1 nor 2. Now moving to the next question. Which of the following statements is or are true regarding planning and operational variances? We know that planning variance is because of uncontrollable factors. Planning and operational variances are calculated when it is necessary to assess a manager on results that are within his or her control. That's absolutely true only if you have a split between the planning and operational variances. Can we evaluate the managers based on the operational variance? If both these are clubbed into one, then we will not be able to assess any manager. So that statement is true. Now the second statement, revised standards are required because variances may arise partly due to an unrealistic budget and not solely due to operational factors. That's also absolutely true. Why are we revising the standards? Because of an unrealistic budget. That is to remove the unrealistic part from the budget. So statement 2 is also true, which means that which of the statements are true? It's option D, both 1 and 2.